Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to do a quick review of paying off debts or knowing which debts to pay off quickly first using velocity banking. Now, if you've never heard of velocity banking, go ahead and click the link below to our velocity banking 101 video. That'll give a great foundation of understanding velocity banking, which is just a strategy to easily pay off debts, reduce the amount of interest that you would normally pay, and also allow you to maintain liquidity and control of your money without really changing your lifestyle. All you have to do is just one little tweak. So go ahead and watch that video and come back here when you're ready. In this video, we're going to do a quick review of how to know which debts to pay off first when doing in velocity banking. So first things first, when you do velocity banking, you need a first thing you need to do is get a budget or write down a budget. So here I have an average American. Paycheck is $5,000, expenses 3,200, savings is 1,800, and cash flow is 0. So if we scroll down, after we've done that, we have to do expense breakdown. So the expense breakdown is going to list every single debt that you have and all your other expenses. You could just combine them into one little bucket. But why is it important that we write down every single expense as a line item? Because every debt that we have essentially eats up into our cash flow, and when we eliminate debt quickly, that frees up our cash flow to eliminate all other debts. So it's almost like a snowball effect. But let's just do a quick review. So remember, each debt paid off and moved to a line of credit frees up cash flow. The bigger the line of credit, the easier it is to transfer debt and increase cash flow, right? So here we have a $25,000 limit. The idea is that once we remove or transfer the debt to the line of credit, and if you don't know what a line of credit, all it is a financial tool that allows you to borrow money, pay it back, and then allow you to borrow it up again once you've paid it back, like a credit card. And a credit card is a line of credit. So back to my point, if you transfer the debt to the credit limit, then this essentially frees up, let's say in this case, $400 of cash flow, right? If I transfer both of these debts, then I move it here. So let's just do this example, 23,000, that's the balance. And then I remove this. So let's go ahead and strike these out. That'll be 2,200 and then 2,800 of cash flow. And so the strategy is you put your entire paycheck. So all you have to do is one little tweak. You put your entire paycheck into the line of credit, which is going to do two things. One, it's going to satisfy the minimum monthly payment. Two, it's going to reduce the overall interest, because if you put the entire paycheck in, the average daily balance of the line of credit is going to be reduced. And so you're going to take out your expenses accordingly, and that will really help you once the monthly payment comes out, because the system or the bank or the lending institution calculates how much interest you accrued on a daily period at the end of the month. All right. So as you can see here, once I've transferred my debt, so I transfer this here to here, I put my paycheck from here to here, and then every single month, once I take out my expenses, the balance will go down by my cash flow, right? So all I have to do is just subtract the previous number by the cash flow, which is 2,800, and then I just kind of rinse and repeat over and over and over again. And so in about, let's just calculate this, 0, 1, 2, 3, 4, 5, 6, 7, 8. In about 8 months, that debt is eliminated, right? So that's amazing. Most people are not going to eliminate this type of debt in 8 months. And we do have to do an interest calculation, but let me just skip that for now. So let me just erase this, because we're going to focus about which debts to pay off in this video. Now, let's say that we didn't have a $25,000 credit limit. We only had a $15,000 credit limit, right? So let's just kind of restart this again. Okay. And so let me just erase this, and let me just erase this. So we have a $15,000 credit limit. Now, if we take a look at our debts, now we see that we can't move both of these debts to the credit limit because there's not enough space, or there's not enough available balance. So now we have to choose, which one do we want to move first? The student loan, the car loan, possibly the mortgage, but not really, because look at that mortgage balance, way too big, right? So let's take a look here. So basically, in order to remove the debt or transfer the debt and know which one to transfer, there's 3 criteria. So one is the biggest payment amount. So which one has the biggest payment amount of these 3 debts? We can see it's the mortgage, right? So mortgage fits number 1. Number 2, which one has the highest interest? We take a look here, it's the car loan. Number 3, which one has the lowest, I'll say, balance? That's a better word. Balance. And then we'll say loan balance. So which one has the lowest loan balance? So 10,000, 13,000, or 210. That would be this one right here. And again, we're going to have to make the judgment call, but you want a loan that kind of fits all 3 of these criteria. So we're not going to do the mortgage because that's the highest balance. And we're definitely not going to do the mortgage because it's not the highest interest, although it's the biggest payment. I would say, in my opinion, the car loan would fit most to 2 of these criteria. So the second biggest payment, and the highest interest. And what we do is we remove this. So again, it's your call to the line of credit. So now the balance is going to be 13,000, right? And what we've done is we've eliminated this as and increased our cash flow by $600, right? So that would be 2,600, and that would be 2,400. So $2,400 in cash flow, and let's see how long it takes us to get rid of this debt, or this line of credit debt, minus 2,400. All right. So now month 0, 1, 2, 3, 4, 5. As you can see, it takes us about 5 months to get rid of this debt. So if our line of credit isn't big enough, fortunately, we can't transfer as much debt, more than one debt, if it's a lower limit like 15,000. So what we do is, once we've done it with the first loan, 5 months, we just rinse and repeat again, and then now we look at our criteria, where which one of these 2 remaining loans fit the criteria. So biggest payment is obviously this one right here. Highest interest is loan number 1, and lowest loan balance is loan number 1 as well. So I'm gonna do loan number 1 because it'll immediately free up my cash flow if I move it to the line of credit. So I'm gonna just do this. I'm going to go ahead and remove this. So let's go ahead and remove that. Now, what we've done is our expenses went from 3,200 to 2,200, and our cash flow is now 2,800. So now we remove the balance here is now it's going to be $10,000 because that's our student loan balance, and then we're just going to rinse and repeat. Page 2 minus 2,800, and so every debt we pay off it'll be a lot faster, paying off the line of credit. So that would be month, let's just do this, 0, 1, 1, 2, 3, and so it'll be paid off in 3 months. Wow, that's amazing, right? All right, so next is the mortgage. So the mortgage is the final thing that you want to eliminate. Again, the mortgage is a little bit more complicated, but if you want to check out how we would eliminate that, go ahead and watch the Velocity Banking 1 of 2 video. We put that in the link below. So basically, it's going to be your call, but it should be loans that fit these 3 criteria as much as possible. Now, one thing I do want to mention is there's this thing called the cash flow index, created by, I think it's a formula created by the Wealth Factory, by Garrett Gunderson. So if you do a Google search, cash flow index, wealthfactory.com, basically it's a formula about with what's calculated by loan balance and the minimum monthly payment. So they have this criteria that if this cash flow index is over 100, that means the loan is efficient, and that's the last loan that you should pay off, right? Whereas under 50 means it's inefficient, and so anything with the lowest cash flow index that out of all the loans, that's the one that you should tackle first. So we'll just kind of do a simple calculation of how that cash flow index number is. So let's just strike through. So let me just put a column here for CFI. Let's see, cash flow index, right? So basically it's the loan amount divided by the monthly payment. So here it's $10,000 divided by 400. Uh-oh. All right, so why is this not working? Oh, I put a comma here. All right, so that's 25. And then same thing here. We're gonna put 13,600. So 21.6. And then the mortgage, which is 210,000, to divide by 1,200. So as you can see, based on the cash flow index, that also kind of meets our criteria too. What we're talking about, that we took off the car loan first, then the student loan, and then the mortgage, right? So the mortgage is the very last thing. And basically, when you look at this webpage regarding the cash flow index, it says that the interest rate doesn't really matter. The only thing that matters is the cash flow index. So very interesting to consider. This is somewhat of a new idea to me, but I wanted to present to all of you because I think it's a great way to figure out also which loans to pay off. I think here this one is a little bit more intuitive when you're looking at debt removal criteria, but this one is maybe more mathematically more sound. But yeah, so just go over those two methods, calculate the cash flow index. So according to this one, because this is the lowest, it's like a quote inefficient loan. And if I get rid of it, then it's going to free up the cash flow. And then this will be the next one. And then the mortgage would be the very last one. Okay. All right, so this is Korean Atlanta Mentorship. If you have any questions, comment soon below. I'm always going to do a plug for a group, so go ahead and feel free to inquire about joining our group by clicking the Google form link below, or by going to the About Us page and then just emailing us, say, hey, I'm interested in joining your group, and then we'll set up a time and a Zoom call to see if you're a good fit. All right, so have a great day, and we will speak next time.